Hello everyone, happy to meet you all once again in this video. This is Sriram here from vibe.school, and today we are going to see how to set up moving averages in your stock charts. Last video we discussed about how to create a watch list, how to input stocks and then gather, keep things ready, set up a chart, everything in investing.com, and we're going to continue the same here. And then let's jump straight to setting up the moving averages. Click on my watch list in investing.com after you log in, and then comes your charts. Now you can add a couple of more companies like I would say HDFC, right? HDFC, just as an example. Right now your watch list is ready. You can add as much as 50 or some 60 stocks, and then you can add some US stocks over here, ETFs. You can keep creating as much as you want. I think there is a limit, but that number is good enough for all our monitoring purpose. So let's go to the charts, and what you have here is a very basic chart. Immediately switches to candle charts. That's our prime, all traders or most of the traders use the candle charts. Remove the volume. In this video we're going to just see about the moving averages. So all professional traders and investors generally talk about three basic moving averages. One is 20-day moving average, then comes 50-day, and then the last one is 200-day moving average. Now the calculation of all these things are available in many websites. All we're going to see is application. We are not going to create any theories or how it is being calculated, and all these things are done and dusted. So let's just focus on how to use them into practical application, right? So here you can go, this is indicators, and then you can type in as moving average. There is moving average, simple, weighted, lot of moving averages are there. There are n number of technical indicators. Just for example, all these are technical indicators. So there are various strategies being developed to trade in, trade out of stocks just to make money. So one major or kind of technical indicator is moving average, and let's type it, and then we are going to use moving average exponential, or in simple terms it is also called as exponential moving average. Click once, click twice, click thrice, right? And you get a 3 here, and the default comes as 9-day moving average, which is nothing but last 9 days and more weightage given to the latest days. So what I'm going to do is click the gear icon here and then change it to 20-day moving average. And then the style, I always prefer the 9-day moving average to be green, and then darken it, and then make the line a little bit thick, and then done. And then next go to the moving average, set it as 50, and then go to style, go to, I generally prefer using orange line here, brightness increase, thicken it, and done. Alright, and the last one is the most important one, that's 200-day moving average, and then go to style. I put it as red. There is a reason for it. Red is something like a kind of key indicator for most traders, and you're done. So all you have is 3 moving averages right away on your chart. So the green one is 20-day moving average, which is pretty much closely following the stock price or stock candles, and then comes the 50-day moving average. Let me make it a little bit thicker, and then comes the 200-day moving average. So the 200-day moving average is the least reactive, whereas 20-day moving average is the fastest reactive or the most reactive one, right? So what we are going to do is create a simple trading strategy. Let's forget about the accuracy, trade in, trade out, profit, losses, and all these things. A simple trading strategy. Let's go to some point in, let's say 2020, right? And the stock is HDFC. Now, the 200-day moving average is the red line, right? Generally, traders exit or close the position when the 20-day moving average cut, or this is called as dead cross. When the 20-day moving average crosses down or crosses below the 50-day moving average and the 200-day moving average, anything crossing below are all called as dead crosses, and anything crossing above or cross over is called golden cross, right? The golden cross is positive, dead cross is negative. So something like that, you can assume it. And here, if you carefully observe, the 20-day moving average cuts the 50-day. So that's a golden cross. And then the 20-day moving average cuts the 200-day moving average. That's a golden cross. And then there's a bullish momentum, right? And then the 50-day moving average cuts the 200-day. Again, there's a bullish momentum. So in a simple trading strategy, any stock is supposed to be trending upwards when the 20-day cuts 50 and the 50 cuts 200 and the 20 cuts 200. So anything above 200 is generally regarded as positive momentum. And anything below 200, people short it right away, right? So in general, as an investor or a trader, long-term position trader, we never go for shorts. We always look for positive trends in company. Kind of shorting a stock is not healthy, and it will, unless you know the strategy, how to do it, we generally don't recommend doing it. So in this case, let's go to some company called Reliance Industries, right? If you carefully observe, there's been a lot of whipsaws. The 20 is dead cross 50, and then the 20 is golden cross 50. You can see it here, and then whipsaws. But if you carefully observe, the 200-day moving average has acted as a support. Let me close or hide the 20 and 50. And if you carefully observe, the stock price, in most cases, except the 2020 COVID crash, has always bounced up and kept up about 200-day moving average. You can search you can search any number of charts. In general, if a stock is healthy in an uptrend, it always bounces and then tries to be close to 200-day moving average. Now in this case, Tata Consumer Products is slightly below the 200-day moving average, and the more it falls, unless there is any bad news or something wrong, the stock price always comes back to 200-day moving average, and then it needs positive news or momentum or some kind of good news from the company to keep zooming up. So in general, if you can see, after the 2020 COVID crash, if you would have bought the stock here, assuming the company is good, there could be lots of ups and downs. But till here, if you would have not sold the stock, it's a good thing, right? You would have probably made from here to here at least 144%, right? In kind of 1.5 years or something, which is too good. But explanation on the charts are pretty simple. In reality, it's difficult. The first thing is nailing down what stock to follow, and then the emotional biases. For example, when you buy here, the stock price does not go always upwards, right? It goes up and down, and then blah blah blah. It goes up and then up, and there is a drop. This is the area when this happens, people feel happy, and then the moment it starts such sharp drawdowns, people tend to sell it off with panic, and then probably it continues a rally. So in general, stock moves up and down because there are millions and millions of traders who execute multiple strategies using technical indicators, and there are also big guys, the whales and sharks, who buy in small chunks over a period of time. Let's say if somebody wants to invest 10 crore or 20 crore, they will not buy it at one shot. They will just infuse the capital spread over, let's say, first quarter or second quarter. They go quarter, like every month, like every 3 months, they keep deploying the capital in slow chunks because there should be enough stocks available to purchase, right? Now in this case, the 200-day moving average acts as a key support line for any stock. And let's say Tech Mahindra. Again, you carefully observe it. If the 200-day moving average is considered as a deadlock, or when the stock price here, let's zoom it to 2020 COVID crash. Here it has crashed once, and if you see, the moment it goes down during normal circumstances, unless there is any bad news, it always comes up, and then it goes down, and then it comes up, right? So that's how the stock price keeps oscillating about 200-day or 50-day moving average. And it's not necessary all the stocks will do the same. Some stocks which are of high momentum will always hover around 20-day moving average, some at 50, some at 200, right? So usually the high dividend stocks or well-matured companies, big companies, will always hover around 200-day moving average. Fast growing companies, strong growers, small caps and micro caps will always hover around 20-day moving average. And then if you see COVID crash, this is the area probably, if somebody would have sold the stock here, it's easy than said, but then this acts as a thumb rule, right? So they would have prevented so much of drawdown, and then they would have bought here, and then you can see the rally, right? And still Tech Mahindra has not crossed below the 200-day moving average. You could ask me the question, there is a kind of one line which is going, but then that's just one line. So how to decide? So what I would generally recommend is, if one line is not, you're not able to take decision, is because this is exactly called as doji. Doji, we will explain it in the future videos. It simply means there is no decision between buyers and sellers. The buyers and sellers are confused, or there is no decision being made whether people are buying in or selling. Let's say here people sold, and then kind of inverted hammer, and then there is a hammer, and then people bought it, sold, and then selling, heavy selling, supported a 200-day moving average, bounced back, but then quite still lower than that, and then there is a hammer, and then it again drops down at 200-day moving average, and then there are buyers coming in. Here we are now, Tech Mahindra, right? So the 200-day moving average is a key support. That's what I want to tell you. And then there comes 50-day moving average, and then comes 20-day moving average. So the 20-day moving average is the most reactive, and the 200-day moving average is the least reactive. And let's look at Facebook now, because it is a stock which has been battered now. So all you can see now is, I'll remove the 20-day, 50-day, and then all you have is 100, right? So here, after the 2020 crash, it went on, supported at 200, supported 200, and then kind of, clumsy here, which means the volatility was very high, and then dropped below, and then people tried to buy it. Let's say whenever it drops below 200-day moving average, people are buying it, which means that shows the confidence in the company. And now here, and then people bought it, and then it went on, people bought it, and then the kind of the quarter earnings or yearly earnings, the forecast was not that great, it was bad, and then the stock price dropped, and now it's somewhere around $200, right? And then what you can see is, I've drawn a line here, right? That's the key support what we are looking at, and exactly at that. And then before somebody buys into it, you have to see whether it is sticking onto it. So that's Facebook. So essentially, for any particular stock, you can go to HDFC and see how 200-day, is it behaving in line with 200-day moving? Is it respecting 200-day moving average, or it is respecting 50-day moving average, or it is respecting 20-day moving average? And you can kind of consider stocks like Trident to an example, because this is a kind of high momentum stock, currently giving good returns. As what we can see is now is there is a huge drop, forget about this, and then now we can see, so suddenly from here to all the way up, this has respected 200-day moving average, but there's always a consistent gap, right? Now let's look at 50-day moving average. 50-day moving average is respected, it's respected, and then it's trying to respect 50-day moving average. Can we also investigate 20-day moving average? Let's close 50 and 200. Is 20-day moving average all clear? The perfect respect is for 20-day moving average, and there is a slight respect for 50-day moving average. So that's how we can identify what kind of stock is respecting what moving average. So it's not same for all. Some high momentum stocks always respect 20-day moving average. It'll just come and then bounce up, just come and bounce up, and then it drops to 50 days. So this is a support. And then let's see, there's a huge gap between the 200-day. So we don't know whether the stock will really hold on to the 50-day moving average, or it could fall all the way down. So we don't know. We have to wait and watch. There's more to it. This may look so simple, but then there is a lot of things to be considered to construct a proper trading strategy. This is just an indicator. Like moving averages are just indicators of what's happening, right? So with this, we'll meet you in the next video to explore more technical indicators and then form a trading strategy. See you all soon.